Well, hi traders, look, we had some wobbles last week when the payrolls dropped, obviously some of the biggest revisions we've ever seen in the history of revisions. But as the dust settles and composure comes back into markets, we're seeing buyers step back in and markets looking like they want to go to all-time highs in the S&P and the Nasdaq as buybacks really manifest and earnings really look to dissipate as we look forward ahead to the end of the month when Nvidia come out and report. But Apple is certainly the talk of the town at the moment as Tim Cook really appeals to Donald Trump with some of the most disgusting scenes we've ever seen, giving him a massive statue made out of rose gold. So something that very much in focus as Apple breaks out. We did see some high volatility, as I say, but that's dissipated and we're seeing calmer conditions play through, and that's leading to some carry opportunities in FX markets. The US dollar, after a bit of a period last week of strength, has actually rolled over, and we're looking to see if that can continue pushing down at in the moment. Now, we are looking at crude on the daily charts at the moment. We're having a look at Bitcoin, and Blake, my good friend, pulls out one of the sexiest charts you're ever going to see in Euro Swiss. It's all going on in the trade-off. Well, hi there. My name's Chris Weston, Head of Research here at Pepperstone. And as always, I'm going to be joined by Blake Morrow from Forex Analytics. And we will be discussing all the factors that are going on in these markets. We're keeping an open mind, looking at the directional trends, the technical setups. And as I say, Blake pulls out a beautiful chart, very reminiscent of something Monet might have created as well. So we're going to go through all those on a multi-asset basis. We're glad you joined us with us today. And as always, some of our loyal followers, obviously you can hit the like button, share it with your friends and family, your dog, your pets, whatever. We obviously want to get the show out there as much as possible. Anyway, Blake, good to see you, my man. How are you?
I'm doing well. You got a problem when you start calling charts sexy. I'm just saying. Yeah.
Why? Why is that a problem? Buddy. Why is that a problem?
Well, I mean, it's a problem. It really, you objectify drawings.
All right,
which is weird.
Subjectify them. No, anyway, I get your point. Sorry, mate. I'm an old school kind of guy.
I'm just kidding.
Wait, I was just coming on, and I'm just interested. I was going to dress up as this new pit boss. You know, the guy that everyone's drawing us a meme that's from Ibiza. I thought I'd go with a little moustache and change my hair. I don't know if you've seen that situation, but I thought it's just hilarious. I thought it's blowing up as a meme, and I thought,
how do you become a meme like that? Like, how does that happen? Like,
I don't know.
Tell me how that happens.
I think it's becoming progressively easier to dislike the English every day, isn't it? I love them. Anyway, let's go into the crazy world of markets. Let's have a look at see what's going on in the financial market. Let's go into the topical thunder. All right, equity moves. Blake, this time last week, certainly on Monday, I was suggesting maybe there could be some downside risks, 3 to 5%. People were looking at the data in the US and saying there's some extra left tail risk coming through now. What happens if we get another poor payrolls number? What happens if we get a weaker CPI number? Should we be talking about 50 basis point cuts from the Fed? I mean, there's one influential analyst that we look at who had even been talking about potential intermeeting rate cuts, something that I think is just not going to happen at all. They didn't do it in 2020. They certainly don't need to see that now. But, look, we're going past the meat of earnings and, we're really looking for the big heavyweight of Nvidia still to come. And, you've got that past us. I know buybacks are a big factor that's lowering volatility and keeping this market in there. But we thought, maybe there's some left tail risk that could cause a sustained period of like slightly higher volatility. The volatility funds take down equity risk. CTAs, obviously, we get breakdown through the recent lows in the S&P futures. CTAs take levels. There was a possibility that we could get a 3 to 5% move down to the downside, and I'm not ruling that could still come. But Apple sort of led us higher on the day. Some of the AI names look pretty good, and it feels like we're back in that mode again of low volatility grinding higher. How do you see that?
Well, I have a feeling that we're in the last couple of weeks of summer. And so that's probably going to keep volatility relatively low, which means that we're going to be in just a consolidation period. I wouldn't be chasing stocks here. I sure as hell wouldn't be shorting them per se. But that's going to be like when we fast forward a couple of topics, I do want to talk about the markets and about summer trading, because I think right now it's vitally important that we have this discussion, because when you're looking at markets, it's really easy to get sucked into like, oh my God, it's not going down, so I might as well just get long. But if you weren't a buyer a couple of days ago when the world was falling apart, and even you saw the the ISM data that came out of the U.S. I mean, we were on the verge of breaking 50. I mean, we're getting real close to the contraction level for services PMIs, which, you know, as a services economy, that's not a good thing. So, and the market's still, you know, we're very well supported. So I again, I don't think I'd chase the market up here. I would just be looking for levels to be on the long side.
Yeah.
You know.
I think Apple's an interesting one. It's been, everyone. I think you coined it a utility stock for some time, and that's a fair assumption. It has massively underperformed, but you know the idea that they're committing $100 billion worth of additional capex or investment on top of the $500 billion we've already seen, with the idea that they're appealing to Donald Trump so they can get a 0% tariff. Look, I think there is a battle between Jensen Huang and Tim Cook to see who can become the best friend of Donald Trump, and I think Tim Cook's put himself in a big favour. But you know, the fact is that Apple are probably looking at 0% tariffs now, and I think Trump may be doing a good policy. And the idea that you're seeing some clear signs that certain companies are going to be producing in the US going forward, and that's kind of his objective. But yeah, Apple has had one of the biggest moves we've seen for a long time, and it's broken out of its range. Maybe there's some upside to chase there. I think the other parts of the AI, or certainly the AI semi space is hard to chase. I'll give you that. You know, sort of Broadcom looks all right. Nvidia, I still think you're probably going to get a bit of a run up into earnings, through 180. But yeah, Supermicro's just been battered overnight. You've seen, some of the other AI players under a bit of pressure, and a lot of the good money's been made. So I think that space has been hot. It's now hard to chase, and you do it on a very select basis. But yeah, I think there's still some opportunities to do there. I mean, yeah, Intel looks interesting, but yeah, I agree with you. It's a tough one to chase, but I feel that there's maybe probably some further upside. I think 62.41 on S&P futures is the level that I'm looking at there. If you break to the downside, I think you're going to see higher volatility, and it all sort of just cascade. So, if long, use that level to lean into and look to exit on a closing break below there.
That makes a lot of sense. And, before we move on to the next topic, I mean, Trump, he also announced that 100% tariffs on any chips that come in the United States.
But that just backs up that backs up what we're saying about, if how many of these big guys are certainly on the chip side. Nvidia, obviously, that doesn't affect them, but you're now going to change the supply chains and buy it from those guys who are producing in America, isn't it? I mean, that's how it works, right?
Yeah, that or you watch how many companies are going to break ground and start applying for permits to break ground in the United States to get out of that loophole. That's going to happen too.
But also, anyway, it's not specifically aimed at China. This is not aimed at China, but could we see any sort of countermeasures from any other countries? That'd be interesting to see.
Yeah, well, I give it that, Chris. It is makes the market very interesting, right? Lots of volatility to play into. Let's move along and let's talk about CPI, because we have now become not like we weren't, but we're really laser focused on being data dependent. And I know everybody's laser focused on the jobs data. What if there's more revisions next month, or this month's jobs, but as we get into it at the beginning of September, if there's a big revisions, people are going to start looking for a 50 basis point cut. But really, CPI is also something that we really have to focus on. This week has been kind of a tame week as far as data goes, in the United States anyway. But CPI is going to be front and center going into next week, and I still think that that's going to be a tough read, and I have to admit that the CPI data, I think, is going to matter almost as much as the incoming jobs data that we get the beginning of September. Can you prove me wrong there, Chris? And that's why I wanted to pass it over to you on US CPI as we look into next week.
I mean, the Fed have made it very clear they're looking at inflation, but I personally think that I think the payrolls number is more important, in the sense that yeah, if we're looking at the core CPI number for next week, the market's pretty sure on the fact that we're going to get 0.3%. If you look at it on an annualized or year-on-year basis, the range of estimates is pretty tight. It's 2.9 to 3.1%. So, it's pretty tidy there. And, if you look at rents within that, rents are falling pretty sharply. So it'll be interesting to see the pass-through into goods and how tariff effective that's going to be, because that's what the Fed are obviously looking at. But that said, I mean, if you're looking, I'll throw the question back to you, if we get a fairly benign number, let's say 2.9%, market's looking at 3%, but let's get 2.9%, they're still, there and thereabouts. We take the components of that, we project them into the core PCE calculation with the PPI numbers, and obviously that gives us a firm read about how that's going to go. But if we've got inflation, let's say we've got core PCE looking like it's going to go up to 3.2, 3.3% by Q4, but then we get a really poor payrolls number, we get another sub 80,000, and we will get massive revisions. I have no doubt about that. That's just the trend, and the way that the response rates are just so low now that you're going to get these big revisions. But if the unemployment rate was to tick up, and that's key, if we get up at 4.3, maybe 4.4%, it brings a 50 basis point cut on the table. Now, if the question to you then is, if you've got some signs of inflation rising, but we've got a weaker labour market, my own thought is that the Fed have to go after the labour market. A labour market's much harder to turn around, and you need to be far more on the insurance side than quashing signs of goods inflation, which have been tariff affected. So surely the focus then has to be, their skew on their mandate has to be towards the labour market.
So you don't buy into the idea that inflation is like a tube of toothpaste, and once it gets out of the tube, it's hard to put back in. I mean, I get that analogy, but it depends what's driving the inflation. I mean, if it's rents going up, if it's wages going up, then that's something that can be hard to stop. But if it's one-off tariff affected situations that are driving goods inflation, sure, and then that's easy to fix, because you can just go and smack demand, and you can leave rates high, and the effects that the pass through on those higher tariffs, you don't even have to raise rates. You just the higher price is just because the elasticity of demand that will have a flow on effect. So goods inflation will have a knock-on effect to demand, and then that will see prices dissipate, and obviously then you get the base effects kicking in. So I think it really, to answer your question, really it depends what's driving the inflation that makes it hard to get pushed back. I mean, I think what happened in 2020, when we saw sky high inflation, 9% inflation in the US, was a combination of massive fiscal stimulus and monetary stimulus all coming together, and that caused structurally high inflation. I think what we're talking about is something slightly different here, though. And to top it off, and I know we need to move along. To top it off, the fiscal spending is slowing down quite dramatically too. So we don't have that tailwind behind us anymore either.
No, well, we're gonna get some stuff coming out there back at the end of the year, but for now, I'll get your point. Now, it's good one. Let's go talk about the US. Your bread and butter. We got a bit excited about potential dollar upside, and I think that was the right call. And I don't disagree with that. I mean, we saw a 3% move pretty quickly in the US dollar against the euro, and I think it was probably hard to justify exactly what was going on with that. Maybe obviously positioning and various factors playing through. But now we've got euro dollar back above 116. Technically looks pretty good. You're seeing a bit of breakdown in dollar yen. Certainly the LATAM FX looks really interesting. Apart from the Chilean peso, but certainly Brazilian real, Mexican peso. They look like they're going to they want to break to new highs against the US dollar. Cable, obviously watching out for Bank of England, but it feels like after it's had its moment, and now we're back to the situation where we're going to run US dollar shorts into once we get past CPI, we'll probably start thinking about running US dollar shorts back into that non-farm payrolls number, and we make new lows coming through.
So you're asking me?
Well, I'm asking you. Sorry, there's a metaphorical question mark at the end of that one.
Okay, okay. Yeah, and I don't disagree with you. However, let me caution you, just like or caution our viewers, same way I would do, or just talking about the S&P. I think we are in the tail end of summer, and so we have these last few weeks chasing the dollar lower here. I have to point out, you look around, and yes, you can look at some of these commodity currencies, for example, like the dollar CAD has pulled back basically to the levels we talked about last week. I showed you a wedge breakout, come back to the wedge, and we're basically at that level, 137.40, 137.50. The Aussie dollar can barely put together a rally. The Kiwi can't even get past its 38% retracement. Euro has snapped back nicely, but the euro looks great on all the crosses. So then you got the Bank of England tomorrow morning, and so you got the Bank of England. They're gonna cut rates. How dovish does the voting flip? Could that give the dollar a little bit of a tailwind? I'd be careful chasing dollar lower here. But as you pointed out, once we get past CPI next week, that might be the indication at that point, especially if it comes in on the softer side, that we can start looking, at that 120 level again in the euro. Yeah. I'd just be a little careful being too premature with that.
You're very careful about chasing equities up. You're very careful about chasing the dollar. This summer, it's got you Mr. Cautious, isn't it?
It does, and that takes us to our last topic.
Hang on, sorry to interrupt. You brought up a really good point I wanted to say, but I want to cut you off. The euro, you talk about the euro. I think that's the place to be. I think, that you're right. It doesn't have to always be about the dollar, but euro Kiwi's now up 5 days in a row. It looks like it's breaking out. I like that. The ECB, I know Holzman is your ultra hawk, but the ECB are basically telling us they want to be done. So from a really simple perspective, I know a lot of it's all discounted, but you are looking at euro done the hard yards, and they may restart again, but you are looking at this really, really, really simplistic way of FX trading. The ECB are done. You're seeing better, it's coming off a low base, but their growth rates are improving. And the US is having some left tail risks. Their labour market is looking to slow it down. Immigration's going to take out workers from the labour force. And you've got to slow down, potentially some modest upside risk to inflation. So, you've got a central bank in the US, which are about to start cutting rates on a cycle again, slower growth relative, and the US. So, I mean, take it as you will. I think euro looks an interesting currency.
I think the euro is a great looking currency, and as Chris pointed out a little bit earlier, I've got the sexiest chart on the block coming, and it happens to have a little bit of euro involved in that.
Yeah,
but more importantly, though, the stability, Trichet's stabilité. You remember Jean-Claude Trichet? The euro's stability may not be the sexiest currency, so to speak. But you get a little bit of safe haven status there too. So anyway, let's move it on to the last topic, and let's talk a little bit about summer markets. And this is something that in our community, Chris, we've both on our European show and our North American show with Michael Brown's colleague over on the UK Trade-Off, Ryan Littlestone. He's been talking about it a lot this week. I've been talking about it every day this week, just to remind people, we are in the last few weeks of summer. So much of the world is on holiday. A lot of people, a lot of traders that I know, my viewership's gone down of our normal consistent subscriber base that religiously comes in. And it's every August. So trading gets a little thin. I start looking for false breakouts, false breakdowns. I start looking at key levels. It's all I really care about. And I'm gonna give you this, Chris. I'm gonna name one trader. His name's Tommy, and he watches this show pretty regularly. So Tommy, if you're watching this, he's a really great trader out of New York. I traded with him for several years, and he loves our show because he thinks we talk about the most relevant topics that need to be discussed. Anyway. Tommy, every morning he thought I'd had some pretty nice charts, but he didn't really care. All he cared about were what levels I was looking at. Yeah. So every morning he'd say, "Hey Blake, what level are you looking at in the euro?" I'd say, "Oh, looking at 116, 115." He'd be like, "Great, thanks." That's all he needed from me. He wanted to know what levels he wanted to look at that were of interest.
The old KISS concept, eh?
Keep it simple, guys. Focus on your levels. Focus on what levels you want to participate in the market in. Don't FOMO it. Say, hey, if the euro gets down to 115.20, I'm a buyer. If the sterling gets down to 131.50, I'm a buyer. If Aussie gets up to 66 cents, I'm a seller. Whatever your levels are, and I'm just blabbering out levels without looking at charts. I'm just giving you examples. But find your levels, trade your levels, and trade around.
It's more than that, though, isn't it? You can't just go and throw levels. I mean, these are levels that you watch price action in. It's how the market reacts into those levels, right?
It is. But remember, your focus, you're looking at charts. Everybody here, you're looking at charts. You're looking at where would be the most optimal time to be long or be short, whatever asset class you're looking at. But wait for those prices. Don't chase markets. The next few weeks, you're going to have a lot of false breakouts. There's not enough liquidity to really push us unless there's a reason, which I'm going to give you some reasons for some sexy charts here in just a few minutes. So, Chris, I just wanted to
it's
wrap
good,
it with
it's
that.
good. I was going to wish we had a bit of song in the background, bit of summer markets. But yeah, anyway, so less of the singing. But yeah, no, some good advice, mate, to be honest. I think, I don't know Tommy, but it sounds like he's a switched on guy. But yeah, I think that's what it. You got to look at your levels, how market reacts to them, and see ultimately how the flows are evolving, and that gives you your probabilities. So yeah, some great tidbits. Thanks you for that. Some good advice. So obviously, if anyone wants any more information about how Blake's looking at those levels, do reach out to him on the show or on socials, and I'm sure he'd be more than happy to dig into those. Anyway, let's go to the technicals that matter. That's the setup. Okay. It's not one that usually gets a run on the show, the Oz 200, the ASX 200. Why? Because it's a value market. It's a bit, dare I say it, boring.
It's ripping, though. It's ripping, Chris.
Mate, when you're looking at the DM global markets at the moment, I mean, Taiwan looks all right, but you look at the DM markets, and we had a bit of a pullback, a few wobbles post NFP, but it looks like the bulls have sort of regained control as we go into, as you talk about these summer markets. But this market is all-time highs. Now, again, this is one that's really, really hard to chase because it's expensive. A lot of the variability has been driven by CBA, which just makes absolutely no sense from a classic fundamental perspective. It's 11-12% of the market, but it's not driven by any kind of fundamental reality of the business. It's very, 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 very well capitalised, one of the best capitalised banks in the world, but it's also trading about 30 times, which is incredibly expensive, and it's been driven by ETF flows and various factors. But look, the ASX is at all-time highs here, which you can't really get any more bullish from a price perspective, but it's been driven by discretionary stocks on fire, because next week we're going to get a rate cut. Yes, you heard it first. I know we got upset in July that we didn't get the cut when the market was pricing 90%, but they are going to do it. Now, if they don't, I've promised to put everyone in the office here a small sausage roll from the food court and a soft drink of their choice. That's how convicted I am that they are going to cut rates, but it's priced in. The market's even pricing a 4% chance that we get a 50 basis point cut, which is not going to happen. But yeah, discretionary stocks ripping, banks are providing support, some little rotation into material stocks. But this is, when you're looking at global equity markets on the DM side, this is it's not the best performing, but it's the strongest in terms of where we are in absolute levels. And, look at it, breakout, came back, found the buyers off the 50 and the breakout point. Can this kick high? Yeah, absolutely. We've got earnings which really start ramping up now into next week. And that 12th and 13th, for all you Aussie-specific viewers or asset traders, 12th RBA meeting, next day CBA earnings. It's going to be the 2-day Aussie bonanza.
Woohoo! That sounds exciting. Ooh. And you know what else sounds exciting, Chris? FedEx on dry ice, drink of my choice, and to Phoenix. Dry ice to Phoenix. You can do that. It can happen. You can make it happen. All right. Let's move along. Great chart, by the way. It's really sweet breakout, and you say it looks vulnerable like you, but I don't know. It doesn't look so vulnerable.
Wow.
I don't know. That's just me. So anyway, hey, Bitcoin.
Yep.
Line in the sand.
The old line in the sand.
Take the May highs. That was the May high at 112,000. It's also the 24% retracement. It's also the 50 DMA. Very simple setup here.
Very simple.
If you're a Bitcoin crypto bull, there's your line. It's at 112,000. You will soon find out if this is a real love affair with Bitcoin, or if it was just a summer fling if we break back below May 19th's high. Get it? See where I'm going with that? So if you do get back below the 50 DMA, you get below 112,000 with any type of conviction, I think you're going to see a pullback towards the 200 DMA, which is 100,000. But also right now, you can see exactly where the bulls are going to try to hold the line. And if you are one of those hodlers, you think Bitcoin's going to 150,000 next, that's your level. I think that's your level that you need to be really cued in on.
Yeah, I remember those summer romances back in the day, Blake. It's been a while, but yeah, obviously looking out the window now in Melbourne, and yeah, we're getting slowly back towards those summer days ourselves, and the sun shines, the birds chirp a little louder, and Mrs. Weston's ever progressively happier by the day. So that's a good situation. Anyway, let's go to crude, because this is an interesting one for me. Look, we did see, the US have obviously been focused very much on putting sanctions on anyone who's buying crude directly from the Russians. Obviously, that includes India. We did see a bit of weakness coming through in the Indian rupee yesterday. Talking about an extra 25% tariffs there. They're very focused on potentially looking at China in that regard as well. India obviously is saying that they've been harshly dealt by and incorrectly singled out. But obviously that's something that is impacting the crude price at the moment. And then we obviously saw the inventory numbers coming out, and they saw about a 3 million barrel draw. And this comes on the back of obviously what we saw on the weekend with OPEC increasing supply. Now, of course, we're going forward. There's a bit of conjecture as to whether they're going to continue increasing barrels, increasing output, normalise that process, and what that's going to mean ultimately for the demand curve and the supply-demand imbalances going forward. But not now. I mean, from a technical perspective, look at that, bang. There's a really strong floor in the price, and that's obviously now given way. It's closed below that level. As a momentum stroke trend dude, I'm looking at this going, well, can this kick? Can the downside build? Can we see that situation manifest into something more? Obviously, Mr. Trump wants to see that happen. He'd love to see lower prices, and then we get back into those 60 levels. Now, if we go below there, so we get back into a rerun of what we saw earlier in the year, where US producers start talking to themselves about cutting back on production, all these factors as well. But I put this chart up there because you can see a very, very strong, well-defined floor in the price. In front month crude and what how we make our cash CFD here. Brent's a very similar situation. Obviously, Brent is much more reflective of what's happening in OPEC. But that floor is now given way. And for technical traders, you talk, Blake, about know your levels. That's a level that's very significant in my opinion. Can this kick? Well, if I want to be short in that situation, you know where your risk is, and you can easily get out the trade pretty quickly.
Got to know your risk. See, that's perfect trading right there, Chris. Knowing your risk. I always try to explain to people, know your risk before you even get in. A lot of newer traders, they don't think about that. They always think about the money they can make. They don't
about the win. I talk about the win rate, and I'm saying for me, it's like, well, yeah, that can work on some, those high frequency mean reversion trades and bits and pieces where, you're not necessarily looking at risk reward, you're just looking at your high win. But for me, in a lot of these trades, you're looking at trying to hold as long as you can. Now, the downside is pretty limited or pretty contained. But yeah, for me, it's some of these strategies you don't even think about the win rate. It's obviously nice to have 100%, but yeah, for me, it's about trying to know where your risk is and trying to get trying to hold as long as possible to get that risk reward trade off. And then, you don't have to win every single trade, and the risk reward, the win rate becomes somewhat less relevant.
Yeah, great point. All right, Chris. So let's go up to the last one, and this is going to be the CAD yen. I brought the CAD yen because, again, this is one of those well-defined levels in the market that I think are really, really good. We had two sources, and one just a few seconds ago that says that the U.S. is going to impose a 15% tariff on all Japanese imports. That came in from Asahi, which the previous headline came in from another source. Anyway. Regardless, we are seeing a little. I'm sorry,
Kiyomi or something. Yeah.
I was trying to back up to see where I put that in. Anyway, regardless, we're seeing a little bit of yen weakness, which means that the Canadian yen is popped up just a hair. But you can see the support. It's really clear. It's at the 200 DMA. There's a trend line, and then there's this 618 retracement. That all comes in right around 106.50, roughly. So while you're above 106.50, your risk is very well defined to be selling yen. And with U.S. imposing potentially more tariffs, that might be a really good setup. And again, if it breaks below 106.50, 106.30, then you know that we're looking for more of a reversal, and maybe the yen takes on the safe haven role. Who knows?
Yeah,
Go ahead.
I said I like the set. I mean, the setup's the setup, isn't it? I mean, it's come off a couple of confluence of support levels, but the other thing as well is on the yen side is that we've seen some 6% wage growth coming through, and that's obviously something that could see it. But the other thing is would you? I don't have a chart up right now, but euro, given that the CAD has been somewhat affected by a falling crude price in terms of trade, what's your views on euro yen?
Oh, well, on euro yen, it's all about 170. Sustained break of 170, it's going to get ugly. While we're above 170, it's hard to be short, at least for now.
Yeah, good call.
Yeah,
nice one. Well, thank you, Blake. You just got the charts in your mind.
I do. I think about it all the time. They're also sexy to me.
Hey, if you're a chart, you've got to be a sexy chart, haven't you? Anyway, let's move on to Play of the Day. Right, well, I'm going to keep it. I'm going to go for a bit of LATAM flavour. Brazilian real. Why do I like this one? Well, we're seeing low volatility once again. The carry trades are working quite well. Yeah, the CLP, the Chilean peso, is probably the exception to the rule. Yesterday, we did see the central bank in Chile, the BCCH, coming out and saying that they're going to restart look to do its FX accumulation program, $25 million, which in the global scheme of things is a drop in the ocean. But for a currency that trades $900 million to $4 billion a day in turnover, that can add up, and it can supply CLPs to the market. So that's probably the exception. But I quite like the Mexican peso. Lower. I like that higher against the dollar. We're not a million miles away from recent lows in dollar mex. But Brazil. I think a lot of the tariff situation, tariff news is now discounted into the price. You got 15% interest rates. You got the highest real rates in the world, or certainly in places that you want to invest in. And more importantly, when you're looking at carry trades, you really got to be looking at the idea about volatility adjusted. You can get really, really, really high carry levels, but you're also seeing incredibly high volatility, like you're saying some of those, really frontier type marketplaces. But Brazil is the epitome of carry. When you get low volatility playing through, people looking to run short dollar positions, you get paid. In that situation, the dollar does offer some carry against most currencies, but it's a poor one when you look at it on a volatility adjusted basis. So, I think this is one that you filled the gap to the downside. It's broken through, so the gap's there. You've got the runaway gap. I think we go trade down to these new lows. Spreads are a bit wider, obviously, than what you're trading dollar yen and euro dollar. But for the movement, for the tactical opportunity, I think you get more than handsomely paid on this one. So I like it from a carry perspective. I like it from the price action, the setup. I think we break those lows very soon.
Wow, that's very Latino heavy, sexy. I like it, Chris. Thank you.
Yeah, mate.
All right, and if you guys like what Chris had to bring, make sure you give him a big thumbs up down below and comment and tell him how sexy that chart is. Yeah. So here's the sexy chart. This is the Euro Swiss, and I wanted to, I brought you a couple of setups last week. Dollar CAD. I think we talked about gold, which hasn't done anything, and then we got the Euro Swiss. The Euro Swiss is set up as my top trade of the second half of the year. Well, it actually exploded higher today as the Swiss president left the United States, tail between her legs, met with Marco Rubio, but she did not end up meeting with President Trump, and so she left empty-handed. Yeah. And those 39% tariffs on Switzerland are going to go into effect. And the thing is if you listen to what Trump wants. He wants pharmaceutical prices to come down. He wants to put tariffs on Roche and the other Swiss giants, and
by 1,500%.
Yeah. Now I'm not even going to go into the math behind all that, Chris. Let's not even go there. But what I wanted to do is since we've got a nice lift on the Euro Swiss, and I've been trading it to the long side, I want to look at what some upside targets are. If we have a simple Gartley pattern, we're looking at a move somewhere up towards 95.25 or so. If it's a full-on butterfly pattern, that takes us up towards 98 cents. And that's not a level that you're going to see. Those aren't levels you're going to see tomorrow. But they're not levels that are outside of the realm of possible, because even if it extends out towards 98 cents, that wouldn't even be the highs that we saw in 2024. So we're in a big multi-year range, and we're at the lower end of the range. So if Switzerland continues to be punished by the United States and by the Trump administration, Switzerland remains in the crosshairs of the Trump administration, we are going to be looking at probably lower levels in Swiss francs. So, the natural is going to be the Euro Swiss in that situation.
That's a sexy chart. That's the sexy chart that I was talking about. Hot damn. All right, nice one, Blake. Thank you very much. Some great intel, some great education on the summer markets, which, once we get through that period into September, then, maybe shit gets real, and maybe we can see a bit of life back in these dogs. These carry trades come unwound. People start de-risking and all these bits and pieces. I hope, personally, that's how I like a little bit of vibe in the market. Anyway, thank you, everyone, for watching. Hit the like button if you like it, obviously, and subscribe and pass it around. And of course, let us know how you're trading the markets. And Blake and everyone at home, see you next week.